Hey guys, Rafa here from the End Game Investor, and today we're going to talk about non-qualifying mortgages and food. What are non-qualifying mortgages? Well, you may remember some 14 years ago in the 2008 financial crisis, there was this thing called subprime mortgages. And what does subprime mean? Well, imagine you have a cut of prime meat and then a cut of subprime meat. The subprime meat means it's not prime, which means it's crappy, which means subprime meant that the credit of the people applying for these mortgages was sub, meaning it wasn't good, meaning these people had bad credit. So they were more unlikely to pay back the mortgage. And instead of calling it crappy mortgages, they just called it subprime. So you'd think that it was almost prime, but not quite prime, but still pretty good. But no, that's not what it meant. It meant crappy. And now, instead of subprime, after Congress passed a whole bunch of laws and regulations forbidding something or other from participating in the mortgage market, now you have something called non-qualified mortgages, or NQMs, which are basically the same exact damn thing. Instead of qualified mortgages, which are qualified to be backed by government guarantees of whatever by Congress, because that is the regulation that passed after the 2008 financial crisis to prevent it from ever happening again. Now, the mortgages that are not qualified to be backed by banks and government guarantees just go to other loan sharks who ultimately, where do they get their money from? They get their money from the same banks that provide the qualified mortgages, except they pass them off to the non-bank lenders for the non-qualified mortgages. And we're going to read an article about this. And instead of subprime, it's called non-qualified, because non-qualified is less scary than crap. And we're going to read two articles, one from May of this year and the other from just a few days ago. And they strike very different tones, but you can see that this is the same phenomenon over again, and we are headed into a chasm, which is fun if you got a parachute. Here's an article from Insider, Business Insider, which is on the inside of business. And so the title of this wonderful piece is Meet the Last Resort Mortgage Lenders Rising from the Ashes of the Financial Crisis to Help Underqualified Borrowers Buy a Home. Well, doesn't that make you feel all warm and gooey inside? They are standing up for the underprivileged and underqualified. They are part of the woke finance community. It is truly beautiful what they are doing.
Would you walk us through a typical day for you?
Yeah, I just stare at my desk, but it looks like I'm working.
May 14th, 2022. And what are they saying about this wonderful group of people that's providing mortgages for those who can't afford them? Because they're very inclusive.
Dear occupant, because of your fine credit history, you have been pre-approved for a money bank charge card. Ooh, baby. Okay, let's see now.
Well, here are the names. Sprout Mortgage. How could you not trust a company by the name of Sprout? Sprout means life. Well, mortgage means death, but that's a different issue. Angel Oak. Wow. Carrington and Athos Capital Group are four of the lenders who promise to help borrowers without a W-2. They offer competitive pricing and say they help those who are on the road to repairing their credit.
What would you say you do here?
I deal with the goddamn customers so the engineers don't have to. I have people skills.
Their specialty caters to investors and everyday borrowers who couldn't qualify for the tight underwriting standards that follow the 2008 housing bust, as well as to the self-employed. Following the subprime mortgage crisis, they've been embraced by some, but haven't played a major role in the U.S. housing finance. Don't worry, this is not flooding U.S. finance. It's not doing it. Calm down, stop freaking out. And this is the last sentence I want to read from this lovely piece by the Insider of Business. Now, with the rest of the mortgage industry shrinking, these leaders are doing better than ever by catering to borrowers who are outcasts of the market because of low credit scores, heavy debt, or their status as non-salaried workers. So that was May. This is now November 1st, 2022. It wasn't even October. I was wrong. It was November. with new mortgages by MoneyWise, with new mortgages down 55%, US lenders are starting to go bankrupt. Could this one factor trigger the worst surge of failures since 2008? I wonder what this is about. I think it's about the non-qualifying mortgages, which I just discussed in the previous article, that we're doing better than ever, and that May piece. A non-qualified mess? NQMs use non-traditional methods of income verification.
Occupation? Butt doctor. Income? Whatever I finds, I keeps.
And are frequently used by those with unusual income scenarios, are self-employed, or have credit issues that make it difficult to get a qualified mortgage loan. They've previously been touted as an option for creditworthy borrowers who can't otherwise qualify for traditional mortgage loan programs. But with First Guarantee Mortgage Corp and Sprout Mortgage, remember Sprout? That was that same firm, a pair of firms that specialized in non-traditional loans not eligible for government backing, recently running aground. Oh, I thought they were doing better than ever. What the hell happened? Real estate experts are beginning to question their value after they've gone bankrupt. Now they are beginning to question their value. That is a beautiful thing. Now, how much, this is my question, how much of the mortgage market did subprime, back when we were naming mortgages after meat cuts, what percentage of the mortgage market did subprime consist in? Is that the way to put it? I think so. Well, if we look at this Fred discontinued chart, Fred is that guy who compiles all of the economic information and data at the St. Louis Fed. I don't know, one guy, Fred, he must be having a lot of fun. So the 2008 total mortgage outstanding was $14.776 trillion. And now, what was the size of the subprime portion of that total? Well, we go to this tab that I conveniently put up here. And this is by the OECD, the Organization for Countries that like to give themselves new acronyms about economics. The Subprime Crisis, Size, Deleveraging, and Some Policy Options by Adrian Blundell-Wignall. The paper revises our previous US $300 billion estimate for mortgage-related losses to a range of USD 350 to 420 billion. So somewhere between 350 to 420 billion was the size of the subprime mortgage market. And now we're even higher than that at 2019, and this has been discontinued because it went vertical in 2020 when the demand for mortgages went crazy, when interest rates and mortgage rates went down to like 2%. So who wouldn't take a mortgage and lock it in? But this is such a stupid game. In case you haven't guessed, 350 billion of $17.76 trillion is about 2%. That was the extent of the subprime mortgage market, of the entire mortgage market back in 2008, when subprime caused the collapse of the entire system. Now, what do we have now in the NQMs? Well, let's see what the article says. We didn't read this paragraph. Let's read it now. So remember, 350 billion of 14.776 trillion, about 2%. Do NQMs signal another housing meltdown? Probably not, says whatever this is. Is it MoneyWise? I think so. It's syndicated by Yahoo, but I think it's MoneyWise because they're very wise about money, these people. Most housing market watchers believe today's conditions, led by stricter lending rules, mean the U.S. is likely to avoid a 2008-style housing market meltdown. Oh, thank God. We're going to avoid a 2008-style housing market meltdown. Why? Because lending rules are so much stricter now, except if you're unqualified. But failures among non-bank lenders could still have a significant impact, because where do non-bank lenders get their money from? They get it from banks.
I think he's talking to you.
The NQM share of the total first mortgage market has begun to rise again. NQMs made up about 4% of the market during the first quarter of 2022, doubling from its 2% low in 2020. So whatever. Okay, so we're at 4% now, which is about double the percentage of subprime back in 2008 of the entire mortgage market. So this, yeah, it should be fine. It'll be fine. Just shut up. Now, I want to talk about one more thing. I want to talk about food. And now, this is really a flaw in Keynesian thinking. You see, when Keynesians want to quash inflation, by which they mean consumer price increases, what they try to do, and they term this quashing demand or subduing demand or bringing down demand. And they bring down demand by cutting the rate of the inflation of the money supply. So I understand how Keynesians can quash demand for things that you do not need for basic survival. But riddle me this, Keynesians, how exactly do you quash the demand for food? Because when people become poorer and they can no longer afford luxuries, what they generally do is they take the money that they spent on luxuries and investments and other capital supplies, and they put them into basic necessities. You cannot squash demand for food. It's not like people decide that they're not going to eat for the next week, because then they're going to die. United Kingdom, new numbers come in at, 14.5%, all-time record high. Germany, 17.7%, it looks like, all-time record high. Italy, almost 14%, all-time record high. And so, but you see, as demand for luxuries goes down, the demand for basic necessities has to go up, because whatever is left, whatever purchasing power can be salvaged from areas of the economy where people were spending so they could push their asset prices higher, anything comes out of that and goes back into food and pushes food prices even higher. And what is another word for this phenomenon where people can afford less and less and spend more and more money on basic necessities? Well, sophisticated economics analysts like myself call it poverty. Well, of course, the middle class, which lost their houses and lost their jobs and lost their savings, well, they can buy krill or plankton.
This also says it can cause red tide poisoning.
But it's so cheap.
I'd like to thank everyone who has signed up to be my patron on Patreon. It's getting really fun over there, and I found a reference to Mises' regression principle in the portion of Genesis in the creation story, believe it or not. Yeah, I found it, and I'm finding some more interesting stuff. So if you're interested in biblical commentary and economics, then yeah, become my patron on Patreon for as little as $3 a month, or sign up for a 2-week free trial of the End Game Investor, where my lovely sarcastic tones are splattered all over the writing and will give you a wry smile across your face. Have a good week, everybody, and I'll see you whenever I feel like it.